In today's session, I'm going to talk about the topic, the greatest enemy of a rational investor. In many ways, uh, I think I can summarize my session today based on what Pogo said. He said, "We have seen the enemy, and he is us." Every investor has what I might consider to be, you might call it your kryptonite. The one thing that can actually drastically either affect your performance, affect your ability, affect your results, influence the process of investing, and that is you. In many ways, the enemy is not without, the enemy is always within. And that enemy in each and every one of us can be tamed, can be taught, can be controlled. Richard Feynman, a physicist, once said that physics would be much harder if electrons had feelings. Now just stop and pause and think about that. The physics would be much harder if electrons had feelings. What that simply means is I walk into this room and I can flick the light switch and the lights would come on. I can flick the light switch again and it would go off. And what makes that process possible is simply the laws of physics. The electrons don't say, I'm not feeling too happy today, and therefore I'm going to take a rest break. Or they don't say, I don't feel too pleased, I'm not in the mood. They follow the laws of physics. You and I, on the other hand, we are, I say unfortunately, the only life form that have been given and endowed with the ability to regulate our emotions. Now, I use the word fortunately because I think it's a gift. I also use the word unfortunately because I think it can be a blessing or a curse. In the famous ancient script, it says, "Behold, I give you today both a blessing and a curse, but choose you which you want." And that simply means that we've been given this incredible mind. And in our mind, we have the ability to use a part of our mind that I call the intellect. And how we use our intellect controls our emotional state. Emotions are and will always be the enemy of a rational investor. Now, investing is an intellectual game. It's not an emotional game. However, we are human beings. And unfortunately, our emotions need to be either sometimes placed in check or controlled. Or in many ways, you have to train yourself on how to regulate your emotions. Psychology plays an incredibly powerful role in investing. In many ways, the great investors out there have one thing in common. They've mastered the ability to control their emotions. They've mastered psychology. They look at investing not simply as an intellectual game in itself, but they look at investing as a rational process. You want to recognize opportunities, understand the opportunities, but not be overwhelmed with emotions. And so in today's session, I'm going to talk about the enemy within, and I'm going to talk about the investor himself or herself. Where do you start? In the previous session, we, in many ways, talked about laying the foundation, and I went through several basic ideas. In today's session, we should be going a little bit deeper. That's my intention. The first thing you have to decide if you want to be an investor. Now, that's even an oxymoron of a statement because everyone is an investor. Everyone is born an investor because when you're born, you're given time, you're given talents, you're given physical attributes, and effectively you exchange your time for whatever you want in life. Therefore, if I invest time in you, both of us develop a relationship. You invest time at work, you develop a relationship and you get compensated. You invest time in a sport, you develop a skill. You could even develop a talent. So everyone is an investor. But in this specific circumstance, I'm referring to financial investors. Understanding yourself is the first step, recognizing that you don't have to be the next Warren Buffett. You don't have to be the next, who knows, great investor. You don't have to be the greatest investor of all time. The first part of the whole process begins with you recognizing and accepting who you are. That's the first. In doing that, what that enables you to develop is what I call an investment philosophy. Every investor needs a philosophy. A philosophy enables you to think. It's a process through which you evaluate opportunities, you recognize possibilities, you're able to, perhaps I use the word discern, when you should perhaps stay and when you should go. A philosophy is a way of looking at markets, recognizing how they work and how they do not work. So for example, in the stock market, if you have a particular philosophy, you might see markets in a particular way. In the real estate market, you might have a philosophy that allows you to understand the real estate market a little bit differently. Likewise, in the commodities market, in the digital asset market, in any market you go to, you need a philosophy, like a grounding set of principles that serve as a guide, like a compass that guides you, tells you when you're perhaps deviating from your true north, but also tells you perhaps when you need to proceed. A philosophy serves as an anchor so that when the waves, the challenging times come, you can stay put and say, this is what I believe in, everything will be fine. I'll give you a very classic example. We're going through an interesting market pandemic period where the markets seem to be reacting to the COVID-19 virus. Depending on the type of investor you are and depending on the type of philosophy you have, you might be panicking. So what you see as potentially a pitfall, someone else might see that as an opportunity. Rothschild is known to have said that the best time to invest is when there is blood on the street. So, in other words, when you see people acting very emotionally, perhaps that's the time for you to be prudent in your behavior. In the words of Warren Buffett, he said that the less prudence with which people conduct their affairs, the greater the prudence with which you should conduct your affairs. So having a philosophy is key. That's the first thing. You need a philosophy, a set of principles that you would use as your true north. What that simply means is that you don't change your philosophy. Now, you could change your strategy, you can change your approach, but seldom should you change your philosophy. Another ways of saying this is, if I bring it closer to home, your values. What do you believe in? You can't decide I'm going to be a tree today and tomorrow I'm going to be a lion and tomorrow I'm going to be a human being, next week I'm going to be a chimpanzee. No, you have to choose a set of principles through which you live your life as an investor. So number one is you need an investment philosophy. Now, the second thing you need, in my opinion, is you need to understand what your time horizon is. You want to invest, but you can only invest for 6 months. Or you want to invest, but you can only invest for 12 months. The funds you have, you can only invest it for 12 months. So it's important to recognize whether you have a short-term timeline or whether you have a long-term timeline. It's critically important. And the reason is simply because in investing, one of the things that I'll be talking about as we move into the latter sessions is recognizing the difference between price and value. And what we try to do in investing is we find good assets. I'll use an example, maybe a good company, a company that is managed by great or very good managers, a company that has what I'll call a competitive advantage. a barrier to entry. In ancient times, it would be called a moat, something that stops invaders from coming in and looting and taking the spoils and taking the wealth of that city. So it's a competitive, protective barrier. But more importantly, a company that is trading or selling at a reasonable price. And here's the key thing. You want a price to be somewhere here at a level that is below what you've estimated as the intrinsic value. So you always want to buy an asset, whether that be a company, a real asset, whether that be a house or building, where the price is below the intrinsic value. And what you hope is that over time, that this price in the marketplace moves up to value. Price and value always have a very, very unique relationship. Price will always come down to meet value or go up to meet value. What you're looking for are assets or opportunities or investments where the price is likely to move upwards to value. Now here's a very, very, very important thing I should say, and I'm deviating slightly, but it's key. Intrinsic value does not stay the same. No asset has an intrinsic value that remains constant. And the reason is simply, in many ways, because of what I'm talking about in this session, because of the involvement of people and emotions. Sometimes you have a high demand, sometimes you have a low demand. And therefore, demand, supply plays a huge role in the value and the price of assets. So, number one, you need a philosophy. The second thing is you need a time horizon. Now, here's the key thing. Even if you identified an asset that had a price at this level and the intrinsic value at this level, what makes it possible for price to move to value in many cases is beyond your control. There are external forces. Sometimes it's just pure randomness. You've identified an asset and it moves very quickly to the value, and it sometimes exceeds the value, and then you can make a profit. However, for that to work, it's time. You have to be able to estimate the time. I'll say this, in most cases, you cannot estimate that time. The process of trying to estimate the time is what we call speculation, because you're guessing. You're perhaps looking back at the past and you're extrapolating. You're like a speculator. It's a guess. No one knows because it's based on so many things that we do not know. So what you need is a long time horizon if you're going to be a long-term investor. You need patience. And therefore, for example, let me give you a classic example to make it really, really practical. Today, as a result of this epidemic that we call the COVID-19 virus, if you play back the hands of time and you go back to the 1st of January, across all markets, the S&P 500 in the United States, the FTSE index in the United Kingdom, and if you go to other countries or other regions, one of the things that was common was that each and every one of these markets were going upwards. There was optimism, there was growth, and so the prices and the values of assets were going up. Suddenly, there was a change as a result of this virus, and as a result of that, the prices are now going down. Now, if your time horizon was 6 months, for example, if you had bought a company or a share in a company or a bond or an asset or commodity, perhaps even oil, in January, the 1st of January, the value of that asset you bought has declined. Now, if all you had was 6 months, now we are already close to the 4th month. So you start to panic. What that means is that if the market goes down by 30% and you have to sell on month number 6, you make a loss. Therefore, the one thing that is critical in investing is recognizing that you have to be flexible with your time horizon. So you need an investment philosophy, you need a time horizon. Now, number 3 is you need to understand yourself from the perspective of your level of risk aversion. How risk averse are you? There is a saying that £10 of loss is felt much more emotionally than £10 of gain. And that's simply because of how our brain works. Most people are risk averse. Some others are not that risk averse. I should say this, everyone is risk averse. The only difference is the level of risk aversion. For you, you might be a 9. The other person could be a 6. Someone might be a 1. It's your level of risk aversion. Your risk aversion should not be seen as something negative. As a matter of fact, one of the greatest teachers of investing, Benjamin Graham, the same person who taught Warren Buffett and Charlie Munger, said something that was beautiful. He said that an investment operation is one upon which, after you've undertaken thorough analysis, promises safety of the principal that you've invested and promises some satisfactory return on your investment. Very important words. An investment operation is one upon which, having conducted your thorough analysis, promises safety of your principal, meaning safety of your capital, and produces some level of return that is satisfactory to you. So the most important thing is safety of principal. And Warren Buffett says the first rule of investing is don't lose money. And the second rule is don't forget rule number 1. The whole idea is, if you combine those two statements with the statement I made in session number 1, when I talked about Albert Einstein, where he said that compound interest is the most powerful force in the world. The whole idea of that is compound interest can multiply upwards, but it can also multiply in reverse. So if you protect your capital, and you can do that intelligently, then you never actually get to feel a sense of loss. But if you're very risk prone and you take very high risks, there is a very high chance that you might lose your capital. And here is the most important thing. I said in the first session that the average person saves up to 10% on average of what they earn during their lifetime. I want you to just think about how long it's taking you to save what you have in your savings pot over the last, say, 4 or 5 years. What that means is, to put in context, if you work for an entire year and you save 10% and you put it in a bank account and you work for 10 years, it means that you've saved, out of the 10 years, you've saved 1 year's worth of earnings. If you lose that entire 1 year's worth of earnings, what that simply means is that you've lost all of the labor for a 10-year period. Therefore, preservation of capital is the most important part of investing. Therefore, understanding your level of risk aversion, how risk averse are you, is critical. Investing is a solo game. You can look to the crowd to tell you how to place your bets. Forgive me for using that word. That word is not a word synonymous with investing, because that word is more linked with gambling or speculation. And I don't mean to use it in that context. But you must decide and depend on yourself. Now, let me explain what that simply means. If you're very risk averse, you have to settle for investments that promise you safety of your capital. What that might mean, to put into context, is that you might decide, I will only buy bonds, what we call sovereign bonds, which are bonds issued by countries. But you have to choose countries that have what we call a AAA rating. Canada, United States, Germany used to have a AAA rating. The UK once had a AAA rating, but it's been downgraded to a AA. So it's still credit worthy. It's still amongst the top best credits in the entire world, but it's lost some of its rating. And part of the reason was because of the challenges we've had as we've tried to make decisions as a nation to be self-governed. So our ratings, if we do well over the next few years, should go back to what it used to be. So you can look at something like Switzerland, the United States, Germany, and they have what we call AAA rating scores. If you buy the bonds of those countries, you're guaranteed to get your money back. On the other hand, let's use a country that perhaps, and I don't intend for this to be to evoke any emotional reaction, but if we use a country where they've struggled, we use Argentina, for example, or Venezuela, for example, they're going through political turmoil. And what that means is that the risk of losing your money if you were to buy the bonds of Argentina or Venezuela is very high. So on the scale of risk, you can decide, I need to protect capital and I don't like risks. And that means you simply buy very safe assets. On the other hand, you might decide, well, I'm okay taking some risk and therefore I might be able to buy stocks. You might decide I'm going to buy blue chip stocks or internet stocks. You might even decide I'm going to take it to the next stage. I'm going to go for something much more on the risk scale, something more risky. So there's something what we call the capital line. The capital line normally slopes downwards. For those of you who understand capital lines in finance or accounting, the capital line slopes downwards, and at the end of the capital line is what we call a Treasury Bond. Like I just mentioned a few of those, the US bond. It's safe. What that means is it's risk-free. And as you go up the line, you increase your risk, therefore you increase the perception of your return. The return is not promised. The perceived return increases. So you have bonds, then you move up from government bonds. You might decide I'm going to go for corporate bonds. Then you move up and decide I'm going to go for stocks. Then you might decide I'm going to go for private equity and then venture capital. You might even go as far as decide I'm going to invest in real estate. So as you go up the risk, the capital line, the risk increases. However, the possibility and the expectation of return increases. Okay, so 3 things I've talked about in today's session. You need to understand yourself. You need a philosophy, number 1. You need a time horizon, number 2. You need to understand the level of risk that you're going to be willing to accept. In investing, there's so many things that are important. To me, in my opinion, as part of my philosophy, my priority is risk control. I don't care too much about making money. I care much more about not losing. So risk control for me is my most important, what I might call, premise for investing. I do not want to lose money. Now, that does not mean that I'm stuck with very safe investments. You can still invest in other asset classes, and it's not so much what you buy, it's the price you pay, the terms of that arrangement. So 3 things: the price you pay, the asset you're buying, and most importantly, the terms of the transaction, whether it be a company, whether it be real estate, or whether it be digital assets or oil or commodities, it doesn't matter. The price, the terms, and the company or the asset itself. That makes a difference. And so for me, the priority on risk control is key. So in conclusion of today's session, I would say that the enemy is yourself. You need to look at yourself in the mirror and recognize that you are your worst enemy when it comes to investing. The pendulum of investing often swings both sides. Sometimes it swings from pessimism to optimism. You may have heard people talk about markets. Markets is a term used in investing to represent perhaps a consensus of opinions. A market is not what you traditionally, I remember growing up, we would go to the market. The markets around London, there's Portobello Market, there's Brixton Market, there's Borough Market, there's so many of the markets around London. You can go into a market and then you can trade. You can buy things and sell things if you so choose. When it comes to investing, when we talk about markets, there isn't, we say the real estate market, or we say the equities market, or the bond market, or the debt market. or digital asset market. What that simply represents, in many cases, is simply a virtual market, but it's a consensus. A market represents people. And a market, the decision a market makes is simply a combination of all the decisions of everyone in that place, all this consensus decision. Collectively, the market cannot be any more superior in its decision than the individual people can be, because a market is simply people, a group of people with an opinion. Markets generally will swing between hope and despair. So today, with this COVID-19 virus, the market is panicking. Everyone is selling. The market is reacting. Here's the most important thing that I would say in relation to that. Events occur and the market reacts. The market is usually reactionary. In some cases, the market is proactive, so the market can anticipate a change. Let me make it more simple. In the United Kingdom, we might have a forecast that the economy will grow by 1.8% this year. We've forecasted, looking at last year, looking at some interesting developments, looking at inflation, interest rates. And so the consensus of economists might come together and say, we believe that the growth rate of the economy will be 1.8%, for example, or whatever that number might be. That is a projection we're making for this year, but we could also then go a step further where economists would say, well, in 2021, the growth rate should be maybe 1.85. So they're extrapolating today's rates, looking at, extrapolating this year's rates or today's rates. They look back at last year's rates and they extrapolate as to what they believe would happen next year. As a result of that, in the markets, all of these investors, individual investors, take that information and they come up with what they believe to be a value of all the assets. If, for whatever reason, there's a change in inflation or interest rates, in the last few days, the interest rates in the United Kingdom has been reduced, that change will cause the market to reevaluate the values of all assets and reprice all assets. So here's the point I'm getting at. In relation to investing, one of the things you have to understand is that the pendulum of hope and despair depends on the emotions and the psychology of all those individual investors. Therefore, in some cases, you might find that there is a lot of optimism. December 2019, there was some optimism. The stocks were going up, property prices were going up, commodities were going up. There was optimism. From January 2020, there's been some pessimism because of the disruption to the supply chain, especially from China. And so a lot of the companies are recognizing that we may not meet our profit targets as a result of the COVID-19 virus. Therefore, they're starting to reevaluate their projections. As a result of that, the market is correcting its expectation of values of assets in the future. Unfortunately, because the market has emotions, although the companies might project a 5% reduction in profits, and although the country might say, well, our growth rate may not be 1.8%, it might be 1.2. What tends to happen is the market is overreacting or starts to overreact. And suddenly you see the prices of assets go down by 10%, not 5, but 10, sometimes 15, sometimes 20. When that occurs, that's when the test begins for every investor. Because the question is then, what is your principle? What is your principle? What is your philosophy of investing? Are you going to listen to what the market is saying, or would you believe in your analysis? You see, in conclusion, let me leave this with you. You're neither right nor wrong because the market agrees with you. You're right because your facts and your reasonings are right. Very important thing to remember.